Hello everyone, welcome to Tesla Daily News. Today is July 16th, Thursday, and the following is the latest Tesla news. According to market data, Tesla shares opened at $399.40, touched a high of $406.59, dipped to $390.66, and finally closed at $394.46 with volume around 31 million shares, slightly below the previous close of $396.18. In technical terms, Tesla shows mild pullback within ongoing uptrend. For investors, this kind of tight trading range after recent strength often signals consolidation rather than a clear reversal, so many traders will watch whether support near the low 390s holds over the coming sessions. According to the Motley Fool, SpaceX's newly public stock has become one of the most hyped IPOs ever, debuting with a valuation around $1.8 trillion. The article argues that, at this lofty level, SpaceX is far less likely to turn a moderate investment into a seven-figure fortune over a typical investing horizon than Tesla was. When Tesla listed with a valuation under $2 billion, it had far more room to multiply. A $5,000 investment at the Tesla IPO would be worth well over $1 million today. In contrast, the author calculates that for a $50,000 SpaceX stake to grow to $1 million, SpaceX's market value would need to reach above $30 trillion, a scenario the writer views as possible but unlikely. The Motley Fool piece is important for Tesla enthusiasts because it reframes Elon Musk-related exposure. Many retail traders are tempted to chase SpaceX as the next Tesla, assuming similar wealth creation potential. The author stresses that starting valuation is critical. Tesla's enormous historical gains came from a small base, while SpaceX is already in mega-cap territory. For Musk-focused portfolios, this means Tesla may remain the more rational core holding, while SpaceX functions more as a long-term optionality bet on bold projects like orbital data centers and massive AI infrastructure in space. The article also notes that SpaceX has already enriched early private investors, suggesting that the most explosive upside phase may be behind it by the time public investors can buy in, unlike Tesla's earlier days. Finanzen.net mentions that veteran value investor Jeremy Grantham is sounding a stark warning about SpaceX's valuation, calling its IPO the craziest in the history of humanity. SpaceX, now worth roughly $1.85 trillion, is, in his view, priced only on extremely optimistic assumptions about future AI and space businesses, even though the company is still running deep losses. He criticizes the prospectus for relying heavily on far-out projects such as space-based AI data centers, Mars colonization, and asteroid mining ideas he says many serious physicists consider unrealistic on investable timeframes. Grantham nonetheless concedes that SpaceX's stock may continue to rise in the near term because of mechanical index demand. The listing has pulled it into benchmarks like the Nasdaq 100, forcing index funds and institutional investors to buy, while the free float remains limited. Longer term, however, he assigns roughly a 90% probability that the valuation will eventually collapse toward more conventional levels. For Tesla followers, this is significant for several reasons. First, it highlights how much of Musk's current financial power and therefore his strategic flexibility at Tesla now depends on extremely high expectations around his broader ecosystem. Second, Grantham remarks that Musk has historically been able to talk stocks up to 5 or 6 times their intrinsic value, then use those valuations to raise capital and build real assets, as he did with Tesla's factories. He notes this is rare, maybe one success out of 100 similar stories, implying that investors should not automatically assume SpaceX will repeat Tesla's trajectory. Finanzen.net further quotes Grantham warning that if SpaceX's price were actually justified, it would imply AI advances so extreme that human society could be fundamentally reshaped or even threatened by super-powerful automation. In his words, if the valuation is fair, we might be living in a world where our robot friends could dominate us, a prospect he finds alarming given the limited governance around AI. For Tesla investors, that tension is important. Tesla's own valuation is tightly tied to expectations for AI and autonomous driving and robotics. A broad AI-driven bubble that eventually deflates could weigh not only on SpaceX, but also on Tesla's multiples, even if the underlying businesses continue to grow. T-Online reports on 2 new U.S. exchange-traded funds specifically designed to give broad exposure to American equities while excluding Elon Musk-linked companies, including Tesla and the newly public SpaceX. Launched by Subversive Capital and registered via Tidal Financial Group, these actively managed funds are called the Subversive Nasdaq Elon Enterprises ETF, ticker QQNE, and the Subversive SUP Elon Enterprises ETF, ticker SPNE. Their explicit mandate is to mirror the familiar large-cap U.S. indexes, but to strip out firms founded, controlled, or led by Musk that are publicly listed. According to the prospectus cited in the article, Tesla and Space Exploration Technologies Corp. are currently the only excluded names, since Musk's other ventures, such as Neuralink or the Boring Company, are not yet publicly traded. The ETF provider is known for niche, often tongue-in-cheek or politically flavored products, and here it is responding to a distinct investor segment, those who view Musk as a concentrated risk factor rather than a visionary advantage. For Tesla shareholders, the existence of anti-Elon ETFs carries two implications. On the sentiment side, it underscores how polarizing Musk has become. Some investors are now willing to pay fees simply to avoid his companies, pointing to worries about governance, volatility, and high valuations. On the flow side, the impact is likely modest compared with the far larger universe of conventional S&P 500 and Nasdaq tracking funds that must hold Tesla. Still, if such exclusion-based products grow, they could marginally reduce passive demand for Tesla shares and add another channel through which controversy around Musk spills into capital allocation decisions. The Neue Zürcher Zeitung notes that Wall Street's biggest banks have posted a very strong first half of the year, and one catalyst has been the gigantic SpaceX IPO, which helped propel Elon Musk to become the world's first trillionaire on paper. For institutions like Goldman Sachs, JP Morgan, Bank of America, Wells Fargo, and Citigroup, the article reports substantial jumps in trading profits and solid returns on equity, supported both by market volatility and by hefty underwriting fees from landmark offerings such as SpaceX. The SpaceX listing, led jointly by Goldman Sachs and Morgan Stanley with support from more than 20 investment banks, initially generated about $500 million in direct fees, with leading banks reportedly earning $75 to $100 million each. As the stock has remained heavily traded and risen post-IPO, banks are now collecting additional commissions from asset management clients eager to gain exposure. For Tesla watchers, this matters because stronger relationships between Musk and major banks, forged through such lucrative deals, can translate into more favorable financing conditions or strategic support for future Tesla initiatives, including potential large-scale capital raises or even complex corporate actions. The article further describes the SpaceX offering as a corkscrew that has opened the market for other IPO candidates, from Korean chip giant SK Hynix's secondary New York listing to anticipated flotations by Anthropic and OpenAI, as well as more traditional consumer names like sandwich chain Jersey Mike's. A vibrant IPO window tends to boost equity market risk appetite overall, which can benefit high beta names like Tesla. At the same time, if exuberance leads to a glut of richly priced deals, it can eventually set the stage for a correction that drags on the entire growth complex, including Tesla and Musk-related assets. According to multiple outlets including LiveNet, Castanet, The Economic Times, and NDTV summaries, the Wisconsin Elections Commission has determined there is probable cause that Elon Musk violated the state's election bribery law during the 2025 Wisconsin Supreme Court race. The commission, composed of both Democrats and Republicans, voted to refer complaints about Musk's conduct to the Brown County District Attorney, who will now decide whether to bring criminal charges. The reports explained that Musk, through his America PAC and personally, offered extraordinary financial incentives to Wisconsin voters. Most notably, he publicly promised to hand out $1 million checks to individuals who voted in the state Supreme Court election, and at least 3 voters did receive such payments, including recipients at a rally in Green Bay just days before ballots were cast. Earlier, the PAC had offered $100 to people who signed or referred signers to a petition opposing what it called activist judges. Overall, Musk and aligned groups spent about $20 million backing conservative candidate Brad Schimmel, yet he lost by roughly 10 percentage points to liberal-backed Susan Crawford in what became the most expensive judicial contest in U.S. history. Wisconsin law prohibits offering anything of value to induce someone to vote, and the commission's motion explicitly states it believes Musk's social media promise of $1 million payouts was intended to induce participation in that election. In parallel, a civil lawsuit filed by the watchdog Wisconsin Democracy Campaign seeks to permanently bar Musk from handing out such payments in the state, alleging vote bribery, unauthorized lotteries, conspiracy, and public nuisance. An earlier attempt by the state attorney general in 2025 to block the checks was rejected by courts after Musk's lawyers argued the giveaways were political speech aimed at building a grassroots movement rather than express advocacy for or against a specific candidate. For Tesla investors, this escalating legal battle introduces a fresh dimension of political and regulatory risk around Musk himself. While the case does not directly involve Tesla's operations, any criminal charges or adverse civil rulings could intensify scrutiny of Musk in the United States, potentially affecting his bandwidth and public image. It may also harden opposition among regulators and politicians who already view him skeptically, influencing everything from auto safety oversight to labor relations. The controversy adds to a growing list of legal and political fronts from union issues to content moderation disputes that investors must factor into any long-term assessment of Tesla's leadership stability and reputational profile. LiveMint and other sources emphasize that after Schimmel's defeat, Musk announced he would significantly scale back his spending on political campaigns. For shareholders, a reduced political footprint could cut both ways. On one hand, fewer political fights might lower headline risk and allow more focus on Tesla and his other core businesses. On the other, Musk has historically used his political and cultural influence to shape narratives around technology and regulation in ways that sometimes benefited Tesla, for example in EV incentives and autonomous driving policy debates. T-Online also underlines how the SpaceX IPO has driven Musk's personal net worth sharply higher, reinforcing his status as a once-in-a-generation entrepreneur for supporters and an outsized single-person risk factor for skeptics. The direct result is that Musk's financial leverage and flexibility across his corporate empire have increased. If SpaceX's valuation holds, Musk has more collateral to support ambitious plans at Tesla such as expanded gigafactory footprints, new battery and AI data center investments, or a push into humanoid robotics without excessive dilution of existing Tesla shareholders. However, if the bearish view from Jeremy Grantham proves accurate and SpaceX's valuation ultimately crashes, the reverse dynamic could come into play, leaving Tesla once again as Musk's primary pillar of financial strength and potentially exposing it to renewed pressure if Musk needs to tap his Tesla stake to shore up other ventures. Putting this all together, the current news flow paints a complex picture for Tesla investors and enthusiasts. On the one hand, Tesla's stock is consolidating near recent highs, SpaceX's IPO has opened capital markets and deepened Musk's relationships with major banks, and risk appetite for growth and AI-linked stories remains strong. On the other hand, the extraordinary valuation levels around SpaceX, the emergence of ETFs that explicitly exclude Tesla, and the new legal storm in Wisconsin highlight meaningful downside in headline risks connected to Musk's persona, governance style, and political activism. For long-term holders, the key questions remain: how much of Tesla's valuation depends on broad Musk-centric optimism versus the company's own execution on EVs, energy storage, and AI-driven autonomy, and how resilient Tesla's shareholder base will be if the surrounding ecosystem, especially SpaceX, faces a sharp re-rating. As always, disciplined risk management, realistic expectations for growth, and close attention to both legal developments and capital market conditions will be crucial for anyone heavily exposed to Musk-related assets. Thanks for listening to Tesla Daily News. If you found this episode helpful, please subscribe and share it with fellow Tesla investors and enthusiasts.